Hello traders, the title of the video is 5 examples of the negation of a trading signal. Alright, so today I have recorded a video that I titled Stock Trader Explain the Negation of a Trading Signal. I hope you have already watched that video. If not, I highly recommend that you watch that essential trading video at 24 Stock Trader YouTube channel, digit 2 digit 4 Stock Trader YouTube channel. One more time, the title is Stock Trader Explains the Negation of a Trading Signal. This time we will be giving traders 5 specific examples of the negation of a trading signal. Very fast, the negation of a trading signal is a reversal of the prior signal, is also a reversal of a market sentiment. To a certain degree, is the cancellation of the original signal. So you have a signal to buy, and now the price is going down. That buy signal has been cancelled, is a negation of a trading signal. The opposite is also true. When we have a signal to sell, but the price is going up, that sell signal has been cancelled, the market sentiment has changed. Alright, so here we will talk about 5 specific examples of the negation of a trading signal. Before we continue, I would like to remind traders that there are many other negation of trading signal. So I'm just giving you here 5 examples, but do not think that those are the only example that we have in the market. So you need to understand clearly what is the negation of a trading signal, or which I explained in that video that I highly recommend that you watch. Alright, the first example is right here. I'm on the yearly chart. Though I'm on the yearly chart, it is also true on the hourly time frame, on the 15-minute time frame, or any time frame. If you look carefully on this chart, we have a bearish candlestick pattern at the top of a bullish move. So I told traders that whenever we hear the word pattern, it's all about the location. Where does the pattern form? Alright, so we have here, you will say a hammer and a bearish candlestick bar. Alright, this is a bearish candlestick pattern, a hammer, alright, with a bit of tail here. This is an inverted hammer, or it can be an inverted hammer. It can be a hammer itself plus a bearish candlestick bar. Alright, so this is a bearish candlestick pattern at the top of a bullish move. So normally, after this candlestick bar is closed, most market participants, candlestick pattern traders, will be willing to sell the stock. Alright, after those 2 candlestick bar, but here we are. You can see that the third candlestick bar is very bullish, creating in fact another bullish candlestick pattern here, which we call a bullish engulfment. So considering this bearish candlestick bar and this bullish candlestick bar, we have now a bullish engulfment. So first we have a bearish chart pattern. Now that the bearish chart pattern, that bearish indication has been cancelled, now we have a bullish engulfment. This is one example of the negation of a trading signal. So those who were selling before, alright, now they are not selling anymore. People are buying instead. The invitation to sell, which is this hammer and this bearish candlestick bar, this candlestick bar, this invitation to sell has been cancelled. The market sentiment is reversing. But you need to be careful a little bit, because I will be recording other video later on to show traders how to handle, alright, if you want to trade it, the negation of a trading signal. The reason why people decided to buy the auto trader before, whenever you have a long candlestick bar here, whenever you have a long candlestick bar, we highlight the high, the low, and the median line. Generally, we will prefer a rally to the median line of the bearish candlestick bar, and from there, we'll implement a top-down trading method. But from the median line, the price continue to go up and even go above the high of that bearish candlestick bar. But you need to be a little bit careful, because if you're on a monthly chart, quarterly chart, yearly chart, this candlestick bar is not yet closed, because today is the 22nd of June. So, no, in fact, I'm on a yearly chart, I'm not on a monthly chart, so it's not yet closed. It will be closed at the end of December. So once this candlestick bar is closed, we need to be careful, because sometimes the price may consolidate. So you say, all right, George, we have a bearish invitation to sell. Now we have, okay, negation of that, okay, signal. Now I must sell. All right. Now I must buy, because you see it start going up. We have a bullish engulfment now. But you need to be careful, because that's what I talked about before. The market pattern will determine the appropriate strategy that we must deploy. Sometimes, if you see that this, the price, instead of continuing to go out, so what you need to do here, if this candlestick is closed, is to draw a line like this and say priority to bullish signal above. That's the way to handle it. If you buy anyhow without using a top-down trading method, the price may switch into a consolidation mode. Sometimes you may see that. So instead of continuing to go out, the bearish trader may come back again and sell it one more time down, and you may see a balanced market. So in all cases, when we see the negation of a trading signal, draw the line. If you want to buy, give priority to bullish signal above, and give priority to bearish signal below. All right. So, but this is just one example of the negation of a trading signal. We have a bearish candlestick pattern, a hammer, and a bearish candlestick bar. But the reason why we have the negation here, because this candlestick bar is too long. As the price reaches the median line, continue to go up. This is a negation of a trading signal. All right. Another example of a negation of trading signal, I'm not going to show you on the chart, I'll just mention it to you, is when the moving average 20 crosses above the moving average 50 or below it. So let me explain that very fast, because we don't want this video to be long. Very often, not always, but very, very often, more than 80% of the time, when the moving average 20 crosses above the moving average 50, the price, at the point when the crossover is occurring, you will see that the price is at a resistance level. So the crossover is taking place here at this vertical line, right? Yeah. But at that point in time, very often, the price will be at a resistance level. Though we have a bullish crossover or a bullish signal, the best approach is to look for an opportunity to sell, because the price is at a resistance level. This is a negation of a bullish crossover. The opposite is also true. When a moving average 20 closes below the moving average 50, it's an invitation to sell, but generally the price will be at the support level. The best approach is to buy instead. This is a negation of a bearish moving average crossover. I've chosen the moving average 20 and a 50 because those are the two moving averages that often exhibit, okay, the negation of a moving average crossover. It's not true for any other crossover. Moving average 20, moving average 50 very often will exhibit a negation of a trading signal. That's the second example. The third example of a negation of a trading signal is when the price forms a higher low after a lower high. Hopefully, if I go to the month daily chart, price form, okay, a higher low after a lower high. I'm looking at my chart to see if I can see one good example here to show you guys. a lower high. Will you agree? Will you agree? Will you agree? That's not good. Okay, just take it from me. That's a negation of a trading signal. Let's go, for instance, to the weekly chart here. So I will draw it instead to save time. So the price is here, right? From a high. Okay, so from a high. Okay, now it form a lower high. Okay, from a lower high. Okay, from a lower high there. As the price coming down, instead of breaking the prior low, it form instead a higher low. Okay, so that's a negation of a trading signal when the price form a lower high, but that lower high is followed by a higher low. Because when the price form a lower high, it's indicating to us that the price is about to form a new lower low. But therefore, the market sentiment has changed right here. Instead of forming a new lower low, the price will exhibit a higher low. This is also one example of a negation of a trading signal. It's a very powerful, okay, a negation of a trading signal. You need to be aware of that, alright? Price form a lower high, but then that lower high is followed by a higher low. That is a negation of the bearish sentiment, alright? Okay? You will also notice sometimes that the price will form, okay, something like this. Hold on, please. There's another negation. I'll mention very fast. Instead of price forming a lower high, price instead will form. Hold on, please. Let me draw my line properly here. Price will form a lower low, but as the price form a new lower low, it will go back up and form a higher low. Again, it's a change, it's a reversal of market sentiment. So price form is in a declining channel, alright? It's in a declining channel from a low, then from a lower low. But instead of having a new lower high, we have a higher high right here. So in fact, what is happening here, the price coming out of the declining channel, forming a new higher high, forming a higher high in comparison to this lower high. So when the price form a new lower low, and that new lower low is followed by a higher high, is an indication to us that the bearish momentum is diminishing. A reversal of the bearish sentiment is about to take place. Is a negation of a trading signal. All right. The fourth example of the negation of a trading signal, I have one stock here. Hold on, please. Okay, I'm going to go back to the yearly chart where we have more example. Here it is. Okay. The fourth example is when we see, for instance, a bearish engulfment, but the next candlestick bar goes above the median line of the engulfed candlestick bar. So here we are. You see, I'm on the yearly chart, but we are assuming, repeat, we are assuming, because the candlestick bar, the bearish candlestick bar here must close first. But because I'm on the yearly chart, is not yet closed. But for the purpose of this tutorial, let's assume that this candlestick bar is now closed on the 31st of December 2017 and is bearish like this. Therefore, we can say that we have a bearish engulfment at the top of a bullish move. Alright, yes or no? But the negation of a bearish signal will occur if in 2018 the price goes above the median line of this bullish candlestick bar and finds support. That is also one example of the negation of a trading signal when we have first a bearish engulfment, but the next candlestick bar managed to break above the median line of the bullish, of the engulf candlestick bar. This is the engulf. It has been engulfed. This one has been engulfed by this one. So this is the engulf candlestick bar. If the next candlestick bar manage to go above that median line, it's a reversal of market sentiment. It is also one example of a negation of a trading signal. In all cases, when we have a clear-cut negation of a trading signal and we want to trade it, we must apply a different time frame trading method. One more warning to new traders: as we are showing this on the yearly chart, very often it's normal, a lot of new traders may go to the 5 minutes or 10 minutes playing with this kind of strategy. Generally, it may not work because it may not work all the time. That's the point. It may not work all the time because the lower time frame is just a market noise. The best approach is, if you are scared of okay, the higher time frame, which you shouldn't, you can use at least 4-hour time frame. All right, fine. Okay, the negation on the 4-hour time frame before breaking it down to your lower time frame to trade it. All right, or at least on the daily chart, look for the negation of a trading signal on the daily chart, and then implement a different time frame trading method before breaking it down all the way to your favorite lower time frame. So don't go and just play with it on the 5 minutes hourly time frame. It may work sometime, but it won't be as solid as it is on the higher time frame using different time frame trading method. That's all. All right. The last example, which is the fifth example of the negation of a trading signal, is when the price is going up under a bearish news. So you may say to me, where is the signal there? All right, the signal here is that we use technical signal, we use economy news also as a signal. All right, we use also decision made by the central bank as a signal. All right, we also use the change of monetary policy as a signal in the financial market. So, for instance, can you imagine that a company came out, okay, releasing their earnings, and they failed to meet the analyst forecast big time. All right, so this is a bad news for that company on that day. All right, but if on that day the stock goes up, is what is a negation of a bearish trading signal. So the news was very, very bearish. Everybody was calling their friend to sell that stock because they have failed big time. All right, and they have a useless management and they are not doing a good job, and people are trying everything to sell the stock. But surprise, surprise, the stock is going up, and it's going up a big time. This is another example of the negation of a trading signal. Or sometime you may see that we have an excellent economy news. For instance, as those who are trading currencies, you may notice that a job creation, no farm employment data came out, and they created more jobs. That they double created more jobs. So the forecast maybe they're going to create 100,000 jobs, and on that day they say they have created 200,000 jobs. That's a very good economy news. But and then you start trading okay, the dollar yen, and you notice that the dollar yen on that day is not having any of it, and it's going down nicely instead of going up. Everybody wondering what's going on. Though we have a very good bullish economy news, the stock is not having none of it, and it's just going down nicely. This is another example of the negation of a trading signal, whether it's a technical signal, economy news signal, or change of monetary policy signal. If the market sentiment reverses, right, it is also a negation of a trading signal. So those are the 5 examples, talking about the 5 examples of the negation of a trading signal. I will not go over it again. I assume that you have understood everything, because I passed over my time. It's now going to be 20 minutes so far. So all I will do, I will just wrap it up. We can have a negation of okay, trading signal, whether it's a candlestick bar, a hammer, and a bearish candlestick bar on the top of a bullish move, or a hammer and a bullish candlestick bar at the bottom of a bearish move. If the price start going up or doing the opposite of the market sentiment, is a reversal of a trading signal. We talk about moving up a 20 and 50 crossover very often. Is this a negation of trading signal? Though one sees a bullish 20 and 50 crossover, the price will go down to retest the moving average 20 before going up. Alright. Another example that we have mentioned is when the price forms a higher low after a lower high. It's a reversal of a market sentiment. It's a cancellation of a bearish indication. Price from a lower high is a weakness. Alright. Now instead of having a new lower low, the price change direction and form instead a higher low. So a higher low after a lower high, alright, is a negation of a trading signal. We also talk about a bullish engulfment. When we have a bearish, we talk about a bearish engulfment at the top of a bullish move, or a bullish engulfment at the bottom of a bearish move. If, for instance, we see a bearish engulfment, alright, but the next candlestick bar goes above the median line of the engulfed candlestick bar, we have a negation of a trading signal. And the last example is when the price goes down. When we have the price goes down, but we have a bullish economy news, or the price goes up on a day when we have a very bearish economy news. So those are the 5 examples of the negation of a trading signal. There are many other examples of the negation of a trading signal, and I will be recording more video to explain to traders how to trade the negation of a trading signal. This is the end of this tutorial. If you have any question or suggestion, put in the comment section, and in due course I will be recording another video to answer your specific question. I recommend to traders to watch that video that we titled Stock Trader Explain the Negation of a Trading Signal at 24 a Stock Trader YouTube channel. If you find this video truly useful, let us know by giving us the thumbs up. If you think that George or you sound very boring to them, this is another useless video, please give us the thumbs down. If you think this is an essential tutorial, feel free to share it on Google+, on Twitter, and also on Facebook. Until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about 5 examples of the negation of a trading signal. We are recording this video because a trader has asked a question, has asked me to record to explain more what is a negation of trading signal. We recorded the first video that we have posted. Now we are giving 5 more examples of the negation of a trading signal. I will be recording other video in the near future when I will be showing traders how to handle the negation of a trading signal, which means trade it like a pro. As always, when you identify the negation of a trading signal, do not just buy or sell straight away. Wait for those candlestick bar to close and then implement a different time frame trading method. This will allow you to control the risk, because when you are applying a different time frame trading method, you will see that the signal is fired, and then you will select a low risk entry point to enter the trade. Another thing I will mention before we go is that the negation sometimes will occur when trader is applying a top-down trading method and then the signal fails. So you enter, everything worked well, you see your setup is bearish, you receive a sell signal, you say alright, you check the economy news, then you select a low risk entry point to buy. The next day, there were other economy news that pop up in the market or in that sector. Now the signal has failed. The choice is not yours. Are you willing to join the other side of the trade or close that trade immediately? What you need to do when a signal fails, you must close that trade and decide whether you want to join the other side or the trade straight away. The signal failure is also a negation of a trading signal. Happy trading to you all, and speak to you soon.